This video looks at an anticipated and permanent increase in the domestic nominal money supply by 10%. We're picking 10% just to give us a number. Again, it's a flexible exchange rate regime, meaning what happened over here doesn't translate to the foreign market at all, so we leave that absolutely unchanged throughout. Now, let's look at this slowly. I'm going to walk through it once verbally and then we'll do it analytically. What's going to happen is, today at time t, the central bank announces and everybody believes that at a future date, they will increase the nominal money supply by 10%. Because everybody believes that today, prices will start to adjust now in anticipation of this future increase. The money supply won't move at all today, but the demand for money will begin to rise as people expect future higher prices and more extra money floating around in the market. So the result is going to be demand is going to start to move today, pushing interest rates up today as the price level begins to rise today. All of that tells us in the end the price level will increase by 10%, so we'll be at a higher price level and there'll be a transition to that higher price level over a long period of time. Hence, the expectations of the expected exchange rate change will increase in this case, because we know in the end we'll go to a higher 10% higher exchange rate for this economy. So we know we will be up here in the final solution. Knowing that today means this changes today. So let's look at that. Money supply doesn't change today, so nothing. But at time t in the future, it will rise up to here. And that increase is a 10% increase. It is known today that this will happen, so prices begin to adjust today up to that higher level. This process we're going to see begins to move the price level here and money demand now. So it's going to creep up, and I could draw a bunch of little curves along here, but it's going to creep up slowly pushing up the interest rate very slowly. We can see that real money demand, which is money, is not changing, divided by the price level, which is rising, means this is actually falling all along here until suddenly the money supply increases. This then rises slowly until we reach the actual change in the money supply. At that time, the money supply jumps out to here, jumping interest rates back down to where they were and leaving the initial steady state interest rate the same as the new steady state interest rate. So there's no change in interest rates over time, because in the beginning and in the end, inflation hasn't changed. And interest rates are the real plus inflation, and inflation hasn't changed across this initial and the final outcome, so nominal interest rates haven't changed. Real GDP didn't change, so real interest rates didn't change, so nominal interest rates didn't move at all either. Now, what happens here on impact, as soon as this is announced and believed that this will happen, again, money hasn't changed yet, but interest rates start to rise, okay? So for sure, this will begin to creep out slowly. But before that even happens, sitting at this date today, when the announcement occurs, markets know that in the end, prices will be higher in the new steady state, and there is a transition. It'll take a while to get there. So they know that in the end, the exchange rate will be 10% higher in the final steady state. The little out infinite sign is for the new steady state. So we were here, and the whole model will end here. Therefore, this goes up today. Okay? The expectation of a change in the exchange rate. So we jump up to here, up to this new value. So right when this is announced, the exchange rate jumps up to here. Now I'm going to draw it precisely, but that's sort of because we're trying to keep it simple. This slowly rises out to here. As that happens, the exchange rate returns by this announcement date all the way to its original level, by assumption, to keep things simple. When you reach this level, money jumps and interest rates jump all the way back. So we started here, we jumped up to here, point B. We crawled slowly down here to point C, and then we jumped all the way back to point B again, to our final steady state. A couple of minor notes. The price process drove everything. Because we know it'll change and there's a transition, it moved this today. Once we move that, everything mechanically adjusts. Two quick comments. This is simplified for undergrad analysis. We're taking this model seriously. There are two things I don't like in this example, but we're going to leave them. They're right there. This model traces out. We're going to do that as our answer. But this and this imply an expected future jump in an asset price, which is not realistic in the real world. Based on something called the asset price continuity principle, we would never anticipate a future jump in an asset price. The markets would adjust around that. But simplified for undergrad analysis, the basics are right. What would happen in reality is somewhere in the middle, we would have to have a mechanism where this begins to adjust up to the new steady state. But this simple, non-dynamic model doesn't quite capture that.